I've talked about that the FOMC will have to keep the time path of real interest rates lower than in 2007 in order to achieve its dual mandate outcomes. And indeed, I think we have to think about magnitudes here. Remember that in 2013, the mandate-consistent real interest rate over the next 10 years is at least 3 full percentage points lower than it was in 2007. It seems likely that the mandate-consistent time path of real interest rates could be unusually low for a considerable period of time. Moreover, these unusually low real interest rates will likely be associated with other unusual financial market outcomes. I'll discuss 3 of these outcomes in some detail. Inflated asset prices, unusually volatile asset returns, and high merger activity. The first consequence of low real interest rates that I just mentioned, higher asset prices, is in some sense the most obvious. Long-lived assets are somewhat substitutable for each other. So investors generally respond to low real TIPS yields by bidding up the price of other long-lived assets, be it gold, land, stocks, or machines. That means that when real interest rates are unusually low by historical norms, asset prices will typically be unusually high relative to historical norms. The second consequence of low real interest rates is that asset returns should be expected to be highly volatile. When the real interest rate is very high, only the near term matters for investors. So variations in an asset's price only reflect changes in investors' information about the asset's near-term dividends or risk premium. When the real interest rate is unusually low, then an asset's price will become correspondingly sensitive to information about dividends or risk premia in what might seem like the distant future. This new source of relevant information should be expected to induce more variability into asset prices and asset returns. Finally, I believe that when real interest rates are low, we should expect to see more mergers. Now, the reason I say that is mergers typically involve enduring current costs in exchange for a flow of future benefits. For example, to initiate a merger, the acquiring firm has to search for an appropriate target. And that search can be costly. As well, after the merger, it may be necessary to undertake a one-time costly reorganization of people and materiel to achieve the anticipated gains in revenue. Businesses will be more willing to pay the upfront cost of a merger in exchange for the anticipated flow of benefits associated with that merger when the real interest rate is low. And it's because you're discounting those future benefits by a lower real interest rate. So in this way, unusually low real interest rates should be expected to be linked with inflated asset prices, high asset return volatility, and heightened merger activity. All of these financial market outcomes are often interpreted as signifying financial market instability. And so this observation brings me to my second key conclusion. I've suggested that it's likely for a number of years to come, the FOMC will only be able to achieve its dual mandate of maximum employment and price stability if it keeps real interest rates unusually low. I've also argued that when real interest rates are low, we are likely to see financial market outcomes that signify instability. It follows that for a considerable period of time, the FOMC may only be able to achieve its macroeconomic objectives in association with signs of instability in financial markets, signs like inflated asset prices, like volatile asset prices and returns, and heightened merger activity.